Thanks a lot for the invitation. So this is going to be joint work with Toni, Ahnert, and Peter Hoffman at the ECB. These are not necessarily the views of the ECB. Anyway, so this is a digital economy, privacy, and CBDC. So this is going to be about how CBDC could help make payments in the digital world. Okay. So the digital world, as we know, has been growing in the sense of we purchase goods more and more on digital platforms. And so for this, we need a digital means to pay. As a result, the cash use has declined. So this is on your right-hand side here. This is the cash use in the Netherlands, which is not really a surprise. Netherlands is a very digitally oriented economy already. What is more surprising is sort of Germany, which is the red dots. So you can see here the decline in cash use in Germany. Having lived in Germany, this is a big deal. Although the decline is not so large. Anyway, so with the digital economy, you have some new business models that have come to appear, and the business model of large tech firms is essentially to monetize our data. Okay, so what they do is that they track us, they track our payments, they track our clicks, and they use this to make money, essentially. So as a result, privacy concerns are growing more and more. So there is a recent paper by Garrett and von Oort in the AER that shows that there is an externality to having our data being used by platforms. In particular, while the platforms might use my data in order to infer Dirk's behavior and therefore charge different types of prices to Dirk. So I'm not internalizing this type of behavior because I'm not affected, or I think I'm not affected, so I don't mind sharing my data. So this is sort of the point of Garrett and von Oort. On a survey conducted by the ECB, actually privacy is sort of the number one concern of the respondents. So 43% of the respondents says that they are concerned about their privacy when they trade digitally. So in this paper, what do? We look at the trade-off of having our data being used by, when we trade digitally. And we're going to ask, has the public sector an advantage at providing privacy? In other words, do we want to have CBDC as a digital means to pay in order to preserve privacy? Is there other ways to go around the privacy concern? So that's the questions that we are after. How do we go after this question? So we study a stylized model of financial intermediation in the digital economy. The idea is not going to look at customers. It's not going to look at people who buy, but it's going to look at the merchants. Okay, so the merchants, they will distribute their goods in two ways. They can either go online, or they can distribute their good offline. Okay, so like in brick and mortar, typical type of shops. Online distribution is going to be more efficient, in the sense that there's going to be a better match if you distribute your good online. Okay, so if everything else constant, you would want to go and distribute your good online. The issue is that when you distribute your good online, you have to accept bank deposits, or you have to accept a digital means of payment, because otherwise you cannot distribute your good online. So when merchants accept bank deposits, the problem is that they reveal information to their banks. Okay, so the bank is going to learn the flows into the deposit accounts of these merchants. As a result, the banks become better informed about the merchant. And in particular, the bank becomes better informed than the competitors, than the bank's competitors. This implies that the merchants become captive to the bank, and the bank can extract rents from the merchants as a result. Merchants anticipate that, and then they may choose to distribute their goods inefficiently instead. Okay, so here the inefficiency is essentially that you choose whether you trade online or offline. Okay, that's the way we model things. It doesn't have to be this way, but that's sort of the story, how we model this story. Of course, the fact that merchants are captive is not new. Okay, this already exists in the literature, and so we play on these themes. Now, introduce CBDC. So a CBDC, so a central bank digital currency, this is going to preserve anonymity. It's going to work like cash. Okay, when a merchant sells for cash, the bank doesn't observe the sales. Okay, and CBDC is going to play in the same way. So even if merchants trade in the digital economy, the trades are not going to be reflected directly to the bank. So the bank will be left in the dark regarding these trades. So not observing payment flows. However, the banks can still elicit some information using contractual arrangements. Okay, you can use separating contracts in order to sort of elicit information from the merchants. However, these contractual arrangements, to work, they have to leave some rents to the merchants. Okay, so this makes online distribution more attractive to the merchants. Okay, so you're going to have more efficient distribution of goods for a larger set of parameters. So CBDC, with CBDC, more merchants end up selecting the better distribution technology, and you also have a better rollover decision when it comes to make other loans. So, now you might ask, and you might have in your head, well, but, why CBDC? Why not use PayPal? Right? PayPal could be could work in the same way. So you don't need a central bank to provide a digital means of payment that would preserve privacy. Just have the market provide it. PayPal is a good example, right? So we take this point seriously, and so we actually assume that here, suppose that you have a digital platform that make loans and issue payment tokens. So PayPal does not make loans, okay? But think of Alipay and Alibaba. Okay, so Alibaba would be the digital platform on which you can distribute your goods, and you can accept Alipay. Okay, but then Alibaba and the whole company is going to know everything about your trades. So what is the implication of having Alibaba and Alipay when Alipay can also make loans? Because this was the original plan before I think the Bank of China sort of canceled it. Well, what is going to happen is that the tokens, when the merchants use tokens, or Alipay if you want, it's going to foster competition in the loan market. Okay, why is that? Well, so now the platform is going to have the information about the merchants, and the platform makes loans. Okay, so the platform is going to have the information to make the loan to the merchant. On top of that, you still have a bank. Okay, and the bank is going to be able to use contractual arrangements to elicit information about the merchant. Given this, you're going to have in equilibrium a competition between the bank and the platform. Okay, and this is going to imply better term for the merchant. So the merchants are going to be very happy about having a platform that issues its own token, because it's going to be able to have better terms through competition between the platform and the bank. On top of that, and that's sort of interesting, that tokens is going to crowd out CBDC. Okay, so if you have a CBDC, but you also have Alibaba that offers Alipay, merchants will go for Alibaba with Alipay. They won't use CBDC. Okay, and the issue is then that you might have a walled gardens that is created around Alibaba and Alipay, in the sense that merchants, they will go there and they won't go anywhere else. Okay, so they will distribute their good on Alipay, and they might not switch to other, possibly more efficient entrant platform. Okay. Now, the way we thought about CBDC so far was that when you trade with CBDC, you actually cannot do anything about the information that is collected through your trades with CBDC. Okay, so you remain anonymous to the bank, and you cannot really do anything about the information that is collected through your trades. And here we want to take a little bit a further step about thinking about privacy, taking this quote by Acquisity, so this is a Journal of Economic Literature article on privacy. that I recommend. It's very good. And they say privacy is not the opposite of sharing. Okay? Rather, privacy is control over sharing. Okay? So retaining privacy means that I have control over who I want to have my information. Okay? That's real privacy. So here, suppose, and that's what we do in the paper, we introduce a CBDC that is designed to allow data sharing, okay? And so you can improve welfare in that case. So here what I mean by data sharing is essentially, you go for a mortgage, but the mortgage lender is not necessarily your bank, okay? The mortgage lender is gonna ask you for your bank transcript, okay? Here it's gonna be the same, okay? What is very different is that when you trade with CBDC, your bank doesn't see your transactions. Okay? So the bank is not going to be informed about your own trades. And so this is going to be, we show that this is actually going to be the optimal way to go forward. Okay? The reason is that you're going to have perfect competition in lending between the bank and the platform, and you actually break these walled gardens as well. So the policy implication for CBDC design is going to be that you don't want to have a restriction on data sharing. Okay, you want to, if you have a restriction to anonymity, then you might face low adoption of CBDC. For some reasons, central banks are very, afraid of having low adoption because they would consider this as failure. It's not necessarily my view, but anyway. And so essentially you want to have CBDC with privacy features such as data sharing that can raise welfare. How much time do I have?
Like 7 more minutes.
Yeah. So because I was planning to go through the setup and then take you through the details. In 7 minutes, I think that I don't want to do that. Let me tell you two things. One thing is about open banking. Okay, so this looks very much like open banking. Okay, except that with open banking, again, the difference is that the bank actually knows your information. Okay, and open banking is about the fact that the bank is going to open up your data to to its competitors, so to speak. Okay, if you want it. But the difference between here CBDC and open banking is that when you use CBDC, the bank doesn't know your trades, doesn't know your data itself. It only knows that it granted you a loan, okay, but it doesn't know what you did with the loan, and it doesn't know, your sales and so on, your financial history. So this is a big difference with open banking, okay? And we show that here you would do better with CBDC. The second thing is about what is the difference between this and a credit report, okay? In the sense that a credit report could, through a credit report, you could choose to reveal information about yourself to, different types of banks. And so, what is the difference with a credit agency? So the difference here is that a credit bureau cannot commit not to sell your information to competitors. Okay, so if the credit bureau would sell information, to Jan-Peter, to Xavier, to Jean-Pierre, I would be very happy about that because they would compete. Okay, the problem is that when the credit bureau would sell to many competitors, I would be happy about that as a customer. The problem is that the credit bureau cannot commit not to sell the information to a monopolist, in which case I wouldn't be happy about that. Okay, so this is the difference here between a credit bureau and a CBDC, that the way we would think about it. Anyway, so here, just let me conclude. If you have data sharing, merchants, they can reveal their data to anyone at any time, but they choose who to reveal their data to, and this is the key here about having CBDC with data sharing.